Hello, this is a recording on the module INV3701. In this recording, I'm going to take you through the first part of the revision and exam preparation for the upcoming exams. So the way I intend to do this, I intend to work through at least 4 past exam papers, mostly focusing on section B questions. My aim, I don't know if I'll be able to achieve that aim, but my aim is for us to go through October, November 2019, May, June 2019, October, November 2018, and May, June 2018. And then I'll also hopefully share the 2017 solutions for you. I think if you can go back at least 6 papers, you'll be fine. And in these recordings, I'm mostly going to focus on section B questions, the long questions. With regards to section A questions, the multiple choice questions, I'll provide the solutions to you when I share this recording via email, so you can work through the multiple choice sections yourself. But usually students struggle with the long questions, and with the long questions, you don't know if you got the answer right or wrong. If you get stuck anyway on the multiple choice questions, you are free to contact me. I won't always be able to get back promptly, but I'll try to do so as soon as I can. So in this first recording, it's going to be focusing on May, June, October, November 2019 section B. I'll just go through the section B questions, the section with 40 marks. And then in your own time, you can work through the multiple choice questions. The solutions I give you via email when I share the link to the video will also contain the multiple choice questions, okay? Right, so let's start going through this. It'll be a short recording, probably almost 30 minutes or even less. So we've been told to use 4 decimal places in our calculations and then round off the final answer to 2 decimal places. That's always important for accuracy. So we've been given, for question 2.1, the first question, we've been given an equity analyst, and we've been told that this equity analyst uses a certain tool to compare share valuations, and she uses the dividend discount model. The firm particularly evaluates shares in terms of justified multiples of sales and book value. Over time, these multiples seem to provide a good check on the market valuation of a stock relative to the company's fundamentals. Nomzamo will derive valuation estimates from selected financial information in respect of 2 companies in the telecommunications industry, namely Azania Limited and Mzansi Limited, for the year 2018. And then we're given the sales per share for both companies, the earnings per share, the dividends per share, the retention ratio, return on equity, book value per share, current stock price per share, and the required return on equity. And then we are asked to determine whether the shares are overvalued or undervalued by comparing the justified price to book ratio, PB, with the market price to book ratio for each share. Now, if you remember the market ratios, like market price to book, you simply take your market price divided by your book value per share, right? So we have a market price to book and we have a justified price to book. Remember, a justified price to book is also known as a price to book calculated based on forecasted fundamentals. So the formula for the market price to book is simply our market price divided by the book value per share. So we can simply take the market price for each company divided by its corresponding book value per share. We get 1.4, that's for Azania. And then for Mzansi, we can take the market price divided by the book value per share, and we can get 2.87, right? So these are the market price to book values. Very simple. All the information is given there. It's just a matter of substituting. So be on the lookout in the exam. If you're asked to calculate a market ratio based on price to book, price to earnings, if it's market, you're simply taking the market price divided by the book value, right? Next, we have the justified price to book. Now, the justified price to book is found on the formula sheet, and it's given as PO over BO. I'll see if I can just open a paper that illustrates that formula for you on a formula sheet. So for the exam, make sure you also have your formula sheet nearby so that you can refer to important formulas that you need. But ideally, it's always better to memorize your formulas so that you save time. Try to see if you can memorize some of your formulas, right? So the price to book formula, you can find it on your exam paper, and it says return on equity minus growth over required return minus growth. Okay, so the formula is found in the section that contains these formulas right here. Here's the formula. This is the price to book based on forecasted fundamentals, or the justified price to book. Okay, here it is. Right. So we need to use that formula right here to calculate our justified price to book. So we say return on equity minus growth rate over the required return minus growth rate. So if we look at the information given for Azania, the return on equity is 16% and the required return is 12%, but we were not given the growth rate. And the growth rate is given by the return on equity times the retention ratio. So for Azania, that's 16% times 50%. That's an important formula. And then that gives us our growth rate, which is 8%. And then this is the formula. Okay, let's finish Tanzania first. So we get the growth rate, and then we substitute that growth rate to help us to calculate the price to book for Tanzania based on forecasted fundamentals. So we can proceed on then to calculate the price to book for Azania based on the forecasted fundamentals once we've got the 8% in our growth rate. Okay, so we say 0.16 minus 0.08 over 0.12 minus 0.08. Remember, 0.12 is the required return, 0.16 is the return on equity, and 8% is the growth rate we will have calculated given the information. So if we do that calculation, we get a justified price to book of 2. We do the same for Mzansi. We have to calculate the price to book based on forecasted fundamentals, 20% minus growth over required return minus growth. We calculate our growth rate, which is return on equity, times the retention ratio, so it's 20% times 0.7, and we get 0.14, right, 14%. So that's the growth rate. And then we substitute that information into our formula, 0.2, which is 20% ROE minus the growth rate over required return minus the growth rate. You'll find that if you do this calculation, you'll get 0.06 over 0, but we can't divide by 0. So the answer is undefined. Undefined division by 0 is not possible. So here we cannot calculate the price to book ratio because the growth rate is equals to the required return. Remember, one of the assumptions underlying the Gordon growth model, which is used when we calculate price to book ratios based on forecasted fundamentals, one of the assumptions underlying the Gordon growth model, the constant growth model, is that your required return is greater than your growth rate. But you find in this case, the required return is actually the same as the growth rate. 70% times 20% is the same as 0.14. Okay, so it means we can't calculate our growth rate in that particular example. So we can't calculate the price to book in that particular example. So we say it's undefined. Okay, so now let's come to our conclusion. So based on the notes I gave you, we know that a share is undervalued if the market price to book is less than the justified price to book. So we can see with Azania that the market price to book is 1.4 and the justified price to book is 2. So we can see the market price to book is less than the justified price to book. So we say that that share is undervalued. Therefore, Azania is undervalued. We would buy Azania if we were asked whether we would buy or sell it. And we cannot say anything about Mzansi because the price to book based on forecasted fundamentals justified, it's undefined. Okay, so that was part A. Part B goes on to say, determine the justified price to sales ratio for Azania Limited. Determine the justified price to sales ratio for Azania Limited. So the formula for the price to sales based on forecasted fundamentals or the justified price to sales is also given on your exam paper. Here it is. Remember EO over SO, this is the net profit margin, or it's the earnings per share over the sales per share, but this can also be called the net profit margin. 1 minus B, this is 1 minus retention, 1 plus G, this is 1 plus growth over R minus G, right? So we simply substitute that information for Azania. They asked us to calculate for Azania. We take the earnings per share over the sales per share multiplied by 1 minus retention, multiplied by 1 plus growth over the required return minus growth, and then we calculate that. It's just a simple calculation for Azania, right? So we're just taking the information in this column, identifying anything that you need to identify carefully. But like I've told you, sometimes it might happen in some exams that they don't give you the earnings per share and they don't give you the sales per share. They just give you the net profit margin. This part, the E over SO, is also known as the net profit margin. Okay, it's the same thing. And remember that this part right here, this is equal to the price to earnings, the trailing price to earnings. So it follows that if we just multiply the trailing price to earnings, which is this part, if we multiply the trailing price to earnings by the net profit margin, we can get the justified price to sales. It's just a neat trick that you can use to answer this question. Okay, it might come in the exam. This part by itself is the net profit margin. This part, 1 minus B, multiplied by 1 plus G over R minus G, is just the trailing price to earnings. Remember, we come across the trailing price to earnings right here, similar to this trailing price to earnings. So it's a shortcut that can help you in the exam. Right. Then question 1.2, an analyst is using market value added to measure the performance of a firm. She uses the information below for the year ended 2019 for her analysis. And then we are asked to determine the market value added. So we've been given all this information on the company. Right. The formula for the market value added is closely related to residual income. And the formula for the market value added is given by the market value of the company minus the total capital at any point in time. So in this particular question, remember the market value of a company is made up of equity and debt. The market value of a company is made up of equity and debt. The debt in this case is 2,000 million, which is 2 billion, 2,000 million. So this is the debt. And then the equity, we take the market price per share divided by the number of ordinary shares. So we say price per share, we say price per share times the number of ordinary shares to get the total equity, not divided by, sorry, that's a correction. We take the market price per share multiplied by the total number of shares. Okay. and that gives us the total equity, which is 6.5. And then we add debt, which is 2,000 million. So these two together, 8.5, gives us the market value of the company. Remember, the company is made up of equity and debt. Sometimes it's also made up of preference shares, but here they didn't say anything about preference shares. And then we subtract the total capital, right? So at the end of the year, at the end of 2019, the end of year capital is 3.5. So we subtract 3.5. This is the end of year invested capital right here. So we subtract 3.5. Yeah, because it's market value of company minus total capital. So we say the total market value of the company, which is 8.5, minus the total capital, which is 3.5 at the end of 2019. And then that gives us 5,000 million, which is 5 billion. So that's the market value added. Okay. And then question 2, it was a 20-mark question. We were told as an equity analyst, you analyze the financial statements of MWC Limited, an automobile manufacturer. From the analysis, you come to the following assumptions and conclusions. We're given the free cash flow to equity will grow by 15% per annum for 2 years and then stabilize to 5% per annum. We're given the most recent free cash flow to equity. This is the most recent FCFE, the most recent earnings per share, EPS. MWC will maintain its current dividend payout ratio of 40%, and MWC has a beta of 1.2. Government bonds currently yield 6.4%, and the market equity risk premium is 5.5%. Calculate the value of MWC share on 31 December 2018 using a 2-stage free cash flow to equity model. So remember, with the free cash flow to equity model, the first thing you do, you calculate the free cash flow of the company in each of the future years, right? The most recent one is 2.52, as we've been told here, right? And then that 2.52 will grow by 15% to 2.898. Then that 2.898 will grow by 15% to 3.3327. And then that will grow by 5% to 3.4993. And then after that, we get the value of equity. Because we're using FCFE, it means we are getting the value of equity directly. But if we were using FCFF, we would be getting the value of the firm, right? So the value of equity will be FCFE 3, the value of equity at time 2. We take the free cash flow to equity at time 3 divided by the required return minus growth. This is the cost of equity. Remember, if it was FCFF, we would say WACC, the WACC minus growth. So those are some important things to remember. So we can calculate the required return using the capital asset pricing model, the risk-free rate plus beta multiplied by RM minus RF. The risk-free rate is the yield on a government bond. The market equity risk premium is 5.5% and our beta is 1.2. We substitute all that information, we get the cost of equity, which is R, and then we can get the value of equity by taking the FCFE3, the free cash flow at time 3. So this is the value of equity at time, it's actually the value of equity at time 2. So the value of equity at time 2 is 3.4993 over our required return minus the growth rate minus G, giving us 43.73, right? Right, so now we need to discount those cash flows. So once we have the value of equity at time 2, we now need to, so once we have this value of equity, which is 43.73, we now need to discount this value along with the other free cash flow to equities that we obtained before. So we take our financial calculator and we put CF0 as 0. We put 2.898 as CF1, and we put 3.3327 plus this value that we got at time 2. So we take the free cash flow to equity at time 2 plus this value that we got at time 2. So we add these two together and we get 47.0627, that's CF2. We enter in a discount rate of 13% and we use our financial calculator to get us 39.42. So this will be our equity value, right? Today at time 0. So since in this case, we were given the free cash flow to equity per share, you see this is important, it's the free cash flow to equity per share. It's not the total free cash flow to equity for the entire company. If it was for the entire company, it would mean that the answer we get here for equity value, we would need to divide by the number of shares. But in this case, since we're given the free cash flow to equity per share, there is no need to divide the 39.42 by the number of shares. So it means this 39.42 is the value we were asked to calculate. That 39.42 is the value of each share. But if this was the total FCFE of the company, we would need to divide this total equity value by the number of shares, right? And then part B was using the same information, but we were told that you decide to determine the impact of a different dividend growth assumption on the value of an MWC share according to the new assumption that dividends will initially grow at 18%, right? After which it will decrease linearly to 5% for a period of 12 years. Calculate the value of a MWC share taking into account the new growth assumptions while keeping the other assumptions constant. So in this case, we are now working with the H model. The H model is found on your exam paper, here it is. So we are now working with the H model. The key thing to tell you that we're working with the H model, the key item that will tell you that we're working with the H model is the assumption where they say that dividends will decrease linearly. When you see this, you should then just think about the H model. And if they give you the number of years for which the dividends are declining linearly. So the H model says D0 multiplied by 1 plus GL. This is the slower growth rate plus D0 times H, the half years of linear decline. GS is the higher growth rate, R minus GL. So here you have to be careful with your calculator. Remember to put decimals. We don't have the current dividend. Remember, the current dividend is calculated as the EPS multiplied by the payout ratio. And remember, because they gave us the most recent EPS, it means that what we are calculating here is the most recent dividend. But if they had given us the expected EPS, it would mean that we are calculating the expected dividend D1. So we take our EPS 1.6 multiplied by the payout ratio of 40% and we get 0.64. So that will be our dividend, right? So that's D. And then H, the half years of linear decline, we just say the 12 years divided by 2, and that gives us 6. Then we substitute that information into our formula. Please be careful with your calculator here. Enter everything exactly as it is, and you get 1.1712 for the top part, and then for the bottom part, you get 0.07. And if you divide these two answers, that gives you 16.73. So that was the answer for part 2.2. And then lastly, question 2.2, okay, they actually put, okay, part B. Okay, that's the answer for part B. And then next, we have question 2.2. So question 2.2 gives us a case study. We're told An INV3701 student uses an example of 3 different companies to illustrate the valuation of shares from the perspective of a minority shareholder, so that's important. And then we're given a lot of information here. We're given Firm A, a 9-cyclical company with a 40-year history, paying a 1.10 dividend per share, right? And it aims to increase dividends by 4% per year. Earnings and dividends have steadily increased over the past 20 years. B is a technology company that has never paid dividends. It's made large investments in new factories and equipment, and it doesn't expect to generate positive free cash flow in the foreseeable future. Then we have C, a pharmaceutical company enjoying high profits and paying dividends. However, the company is selling a drug coming off a patent in 3 years with no other drugs in the pipeline. They expect a very high growth rate, but they expect that to drop abruptly in 3 years and settle at a lower growth rate. And then here, as briefly discussed, the appropriate valuation model for each of the 3 companies. So sometimes trying to think back on things you've already calculated in the exam can help you to answer such a question. We've just touched on a question where there's high growth that declines for a number of years. So we can use some of that information to help us to answer question 2.2, right? So let's just discuss the type of valuation model that would be appropriate in each scenario. And let's also give the reasons why. Okay, so let's start with Firm A. So a discounted dividend valuation model would be most appropriate for Firm A because the firm has a steady, long history of dividends. Future dividend payment is predictable. In particular, we can use the constant growth model to determine the price of the share in this case. And then for Firm B, the most appropriate would either be the residual income valuation model or the price multiples valuation. And this is because the firm does not pay steady dividends and it is not expected to generate positive free cash flow into the foreseeable future. And we've also taken a minority perspective. So the minority perspective means that we cannot use the free cash flow to firm approach. And then lastly, here we can also use the discounted dividend valuation model, in particular the H model. This is because we start with a high growth rate when the company is experiencing very high profits, and then that's going to decline for a number of years, 3 years, before settling at a lower growth rate. So you need to be comfortable with being given a case study like this with maybe up to 10 marks, and you need to be able to discuss. From what I've seen, the things they tend to ask about in the exam that have to do with theory are usually questions on the different types of valuation models, as well as questions on the equity valuation process. Please make sure that those 2 parts of theory you're prepared to come across them in the exam. 1, the different types of valuation models. 2, the equity valuation process. And also, I've also seen a lot of past questions that ask on factors that affect the growth rate, factors that affect the dividend growth rate. That can also come as a question in section B with a lot of marks. Okay. And then the last question, question 2.3. Question 2.3 said, identify and discuss 2 cases of when it is most appropriate to use the residual income model. So you see these cases that ask us when is it appropriate to use this model or that model and so forth. So the residual income is most appropriate in these cases. Firstly, when a company is not paying dividends, so its dividends are very unpredictable. And secondly, when a company's expected free cash flows are negative within the analyst's comfortable forecast horizon. And lastly, there is great uncertainty in forecasting terminal values using an alternative present value approach. So these are the instances in which the residual income valuation model would be most appropriate. But this paper, they just wanted 2 reasons, but I've given you 3. And when we say terminal values are uncertain, we mean calculations like these ones. This is a terminal value. We mean calculations like these ones are uncertain. When we get to a certain time in the future, after forecasting, and then there's uncertainty with regards to a value like this. Okay, so that brings us to an end of this recording that was taking you through section B of October, November 2019. So as I've said, the memo also includes the multiple choice section questions. For the sake of time, I didn't go through these, but you can go through them. Just practice, try to see if you can follow. If you have any queries or questions and you get stuck anywhere going through these 30 multiple choice questions, you're free to let me know. But a lot of the things are things we covered during the semester when we were working through different questions. Okay. So thank you very much for listening to this first part of the revision class. I'll share with you the second part in the next recording. I'll be looking at May, June 2019, section D. And then I also hope to look at the 2018 papers in the same way. So any questions and queries, please feel free to let me know. I won't always be able to get back to you promptly, but I'll try to get back to you as soon as I can. Thank you once again for listening.